Welcome to Newshour. Well, he keeps telling us, doesn't he, that tariff is his favourite word. And now US President Donald Trump doubles down on his global trade war by imposing sweeping tariffs on steel and aluminium imported into the United States. He says it will level the playing field for American manufacturing, but it also threatens to increase prices for consumers. Kate Fisher has more now from Washington, D.C.
Guy, this is the latest salvo in Donald Trump's trade war, something he says he's waging because he wants to correct perceived imbalances in global trade, as well as to reignite domestic industry here in the US. And certainly the steel industry here in the US is welcoming this. They say these tariffs will supercharge it, allowing them to offer more high-paying jobs and really invest domestically here in America. But it is a risk because although it may help the steel industry, it's going to increase costs for those industries further downstream that use that metal in their products. Industries like car makers and food packagers who need it for things like cans of soda. They say that it will increase the costs of a key ingredient for them, meaning they will probably have to pass that on to consumers. And overall, they say it will have a negative effect on the US economy. And certainly we do have evidence from the last time Donald Trump was president in 2018 when he enacted steel tariffs then. Yes, it did, it improved profits for the steel industry, but it had a negative effect on other industries. And overall, there wasn't a net benefit to the US economy. This is the first time in his second term that he's imposing a single set of tariffs across the whole world. And the concern from many economists and analysts is this could ignite a truly global trade war. And of course, we still have the threat that more tariffs are coming next month. He's suggesting there will be reciprocal tariffs, and that once again will offer a jolt to global trade and have effects all over the world. Kate Fisher for A News in Washington, D.C.
The European Union remains another critical actor in this global trade battle. Brussels has unveiled countermeasures in response to the Trump administration's decision to impose a 25% tariff on steel and aluminium imports. The EU has promised a proportionate response and will begin adding duties on $28 billion worth of US goods from next month. William Denslow has the latest for us from Brussels.
The European Commission describes the tariffs as a tax that will hurt both sides of the Atlantic, both businesses as well as consumers. The EU says they are unprovoked and unjustified and call on Washington to reverse this decision to impose broad-based tariffs on steel and aluminium imports to the tune of 25%. It's set to be worth roughly $28 billion, and the EU says it will respond in kind. Donald Trump, the US president, says these tariffs are needed to really level the playing field, as he sees it, when it comes to global trade. That is a point dismissed by the European Union, describing it as unjustified and harmful for a trade relationship between the EU and US that's worth roughly 30% of global GDP. When it comes to these countermeasures, well, the EU says it will come in two parts. The first on April 1st, a slap back of tariffs we saw in place during Donald Trump's first term in office, tariffs from 2018-2020 on things like Harley-Davidson motorcycles and bourbon. The second tranche of tariffs will come into effect mid-April. Broader tariffs impacting things like industrial goods, agricultural products like soybeans, where the EU says they can limit the impact on EU citizens because they can pivot simply, according to the EU, from US soybeans to other markets like Brazil. This gives us a 2-week window or so before these tariffs take effect, and the EU says they hope that this period will be used to negotiate with the US. If not, the message from the European Commission here in Brussels is that they say they are fully prepared to retaliate. William Denslow for A News, Brussels.
Well, investors have become increasingly alarmed at the uncertainty caused by Trump's trade war. Markets have plummeted in value in recent weeks, but it seems some technology stocks have been bucking the trend and weathering the economic storm. Let's go to New York now and speak to the CEO of Hyperframe Research, Stephen Dickens. Stephen, always great to speak to you. Macro conditions then look pretty dicey, don't they? But not bad enough, it seems, to dent enthusiasm for some of these big tech stocks.
So, Guy, if you've been watching tech stocks, you've noticed really a wild ride lately. The big story here is the AI trade. It's still alive and kicking, and the fundamentals we've seen in this earnings season have been positive, even if the macro headwinds have sparked some sell-offs. So, looking at some of those numbers from this previous earnings season, Q4 fiscal for Nvidia, the big name here, revenue hit 39.3 billion, up massively year on year. That was all driven by an insatiable demand for AI chips. Their guidance for the for next quarter, that was 43 billion. That company's still growing massively. If you look at Amazon AWS, they pulled in 28.8 billion in Q4 2024, part of a 187 billion wider earnings for Amazon more generally, showing particularly there I was focused on the cloud and infrastructure growth. Microsoft's cloud business topped 40 billion, with total revenue for the company up at 65.5. That was up 16%. Google Cloud grew 30% to 12 billion as part of their almost $100 billion quarter. Then you even look at players like Oracle, HPE, Lenovo and Dell. Oracle's cloud infrastructure business is growing at almost 50%. They posted 49%. And even some of those traditional OEMs like HP and Dell saw double-digit AI system growth. So the numbers are strong everywhere. Growth is there. We're seeing the fundamentals good from a tech sector, especially in AI and cloud. But here's the catch. Despite these blockbuster earnings, we've seen a sell-off of late. Why is that? Simply, Guy, macro factors. Rising interest rates, inflation flares, trade war jitters. All of this is spooking investors. The S&P 500 tech sector's taken a hit, with some stocks shedding 5 to 10% post-earnings. We saw this recently with a whole bunch of names. You know, apart from Nvidia with their solid numbers, we've seen some really strong sell-offs. If you look at Tesla, they've as just a headline name as part of that Mag 7, they've lost almost half of their market cap. We're seeing obviously pressure with Elon Musk's efforts in the Trump administration. We're seeing that impact the stock. European numbers are down for deliveries. All of these are starting to sort of come home to roost for Tesla. I'm still bullish long term on the prospects around full self-driving and their autonomous robo-taxi play, and also what the company's doing around AI. But I think we're seeing a general sell-off. The takeaway, fundamentals remain robust. AI is not just hype. It is delivering. We're starting to see now, 2 years into this cycle, that companies are investing heavily. We're seeing those hyperscalers investing capex, over 300 billions worth of capex being invested by those guys on the build out. So I think all of that remains positive from the fundamentals of the tech sector, but we're really just reacting to the macro at the moment. We're also seeing some profit taking. We've been on a upward trajectory of over the last sort of maybe a year, 18 months. So we're seeing that profit taking.
Stephen, give us your sense of how you expect tariffs, trade wars to impact global markets then over the next few months. Is the drop in value likely to continue?
So with regard to trade wars, Guy, they're starting to heat up. We've seen a continual flip-flop. We're seeing the Trump administration go with its America First playbook. We're seeing tariffs across the board, particularly on China. with a 10% tariff. Then we're seeing Mexico and Canada. Trump's there flip-flopping. And whilst I think everybody knows tariffs are coming in some structure, it's really, really hard to predict what's going to happen there, given the gyrations we go through on an almost daily basis. So the big picture, tariffs could potentially jack up costs. Think electronics, cars, anything with parts. The supply chains coming from China, obviously, but we also see a lot of cross-border in North America from the likes of Canada and from Mexico, particularly in automotive. And we're seeing that bill of materials change for automotive. So gone are the days where these are pure manufacturing, sort of heavy industries. We're seeing obviously the likes of Tesla, its Shanghai plant, margins could be squeezed there. We're also seeing this play out in the supply chain for some of the big tech names I was mentioning earlier. The Nvidia, the HPEs, the Dells, the Lenovo's, all of those guys all rely on Asian components and very complex supply chains. So we might see higher cost margins. We might see supply chain shocks. All of this is really hard to predict given the what we're seeing from the Trump administration. But what we're seeing starting to happen is companies are adapting, and they're adapting fast. Just look at TSMC, the world's largest chip manufacturer, Taiwan Semiconductor. They're based out of obviously Taiwan, but they're starting to double down. They've recently announced a huge investment project, doubling down. Numbers are sketchy, but they're saying upwards of 65 billion in a project in Arizona. Now, how much of these are sort of counting investments that are already being slated? We saw Apple come out and say that they're investing and committing 500 billion over the next decade to build AI infrastructure in the US. Obviously, Apple's got a huge presence in the US. So I always question these types of announcements. Is this counting spend they've already committed or would likely spend anyway? If you look back over the last 4 or 5 years, these numbers jibe with where Apple were. So what does this mean for markets? I think short term, expect that sell-off to continue, expect turbulence. If tariffs drop, stocks tied to China like Tesla and Nvidia could drop. So it's really hard to predict. I think we're seeing this play out in the macro, current market trends, really tough to predict what's going to happen. I think some longer term secular trends that I'm going to be thinking of is the CHIPS Act starting to play out. We're seeing Intel lean in with fabs. They've had a wild ride of late, but I think some of these trends around building infrastructure, we saw CoreWeave announce their IPO in the last week, 10 days. So I think there's a strong build out around industrialization at a data center level in the US. Bottom line here, Guy, trade wars are redefining how goods and tech move globally. We're seeing a paradigm shift. We're seeing the likes of TSMC. We're seeing Apple. We're seeing the Stargate project that was announced with much fanfare a few weeks back. All of that means that these companies are showing fealty to the Trump administration and betting on America. Markets might wobble in the short term, but I think the AI trade is still there. I think the longer term play is bet on American exceptionalism, bet on the technology sector, and bet on AI being a secular trend that defines where the markets are going for the next decade. Guy, thanks very much for having me on the show.
Stephen Dickens in New York for us. Thank you very much indeed for your analysis as always. Well, that is all we have time for on this edition of Newshour. Thank you very much for watching, and please do join us on A News for plenty more news and analysis to come.